Have you ever looked at a wildly successful person and just thought, man, they've got the golden touch. Everything they do just magically works out. Well, listen to what Brad Pitt said when he accepted a Screen Actors Guild Award. He said, I've been banging away at this thing for 30 years. I think the simple math is, some projects work and some don't. He doesn't belabor it, he just moves on to the next. Let's dive into this, because what Pitt is describing here isn't just Hollywood modesty. He's actually tapping into a massive, underlying mathematical reality that dictates extreme success across the board. Even for global superstars, it is entirely a numbers game of hits and misses.
Welcome to this explainer. Today, we are exploring a really fascinating concept, how tails drive everything. Our core thesis is that in business, in investing, and honestly, in life itself, a tiny, microscopic percentage of outlier events account for almost all of the rewards. By looking directly at the data, we are going to completely shift how you view success, failure, and risk.
Let's start with Section 1. The secret behind genius.
We really need to shatter this illusion that brilliant, historically successful people have some sort of near-perfect track record. The truth is much messier, and frankly, a whole lot more encouraging for the rest of us. Take Heinz Berggruen. He fled Nazi Germany in 1936 and didn't show any particular promise in his youth. Yet, flash forward to the 1990s, and he was one of the most successful art dealers of all time. In 2000, he sold a massive collection to the German government. The private market value of that collection was well over $1 billion. So how did he pick the winners early on? Was it pure skill? Incredible luck? Well, Horizon Research actually points out that great art dealers essentially operate like index funds. It's highly likely that 99% of the works Berggruen acquired were absolute duds of little to no value. But he bought in vast quantities and he waited. That 99% failure rate just doesn't matter when the other 1% turns out to be Picassos and Matisses. He could be wrong almost all the time and still end up stupendously right.
And this brilliantly illustrates our next example. Take a look at this massive number, $8 million. This represents the earnings in just the first 6 months of 1938 for a movie called Snow White and the Seven Dwarfs. Now, before this, Walt Disney's very first studio had actually gone completely bankrupt. By the mid-1930s, Disney had produced more than 400 cartoons. Most were beloved by audiences, but financially, most lost a fortune. It wasn't until Snow White made that unprecedented $8 million that absolutely everything changed. That one hit paid off all the company debts, funded employee bonuses, and quite literally bought the Burbank studio that they still use today. Out of the several hundred hours of film Disney had produced up to that point, business-wise, just the 83 minutes of Snow White were all that mattered.
So the crucial point we're getting at is this definition right here, tail events. In statistics, long tails are the farthest ends of a distribution of outcomes. In finance and business, they are where a very small number of events account for the vast majority of results. Basically, anything that is huge, profitable, famous, or influential in our world is almost always the result of a tail event, an outlying 1 in thousands or 1 in millions occurrence.
Let's move into Section 2, Tails Drive the Market.
So we've looked at art and animation, but this exact same concept perfectly dictates massive financial markets. Correlation Ventures looked at over 21,000 venture capital financings from 2004 to 2014. Venture capital is famously risky, right? And the data definitely proves it. 65% of those investments flat out lost money, gone. But look at that tiny sliver, just 0.5% of investments. That is roughly 100 companies out of 21,000 that generated a 50 times return or more. That tiny fraction is where the vast majority of the entire industry's returns actually come from. The world only allows a few mega successes, and they end up paying for all the failures.
Now you might be thinking, well, that's just risky venture capital. Let's see how this plays out when we look at the safer public markets. This is JP Morgan's data on the Russell 3000 Index, a massive broad collection of established public companies tracking since 1980. The reality here is shocking. 40% of these established companies lost at least 70% of their value and never recovered. The index itself has gone up 73-fold since 1980, which is a spectacular return. But effectively, all of those overall index returns came from just 7% of companies that significantly outperformed. Inside a boring, diversified index, you have the exact same dynamic as wild venture capital. Just to prove how incredibly common this failure rate is among big companies, consider the timeline of Carol Co. They were a member of the Russell 3000. They produced massive, culture-defining blockbusters like Rambo and Terminator 2. In 1987, they went public. By 1991, they hit $500 million in revenue and a $400 million market cap.
But then the blockbusters stopped. Just 5 short years later, in 1996, they declared bankruptcy. The stock went to absolute zero. Carol Cove's story isn't unique at all. It's a perfect representation of the 4 in 10 public companies that experience catastrophic loss over time.
And this reality spares absolutely no industry. More than 50% of public tech and telecom companies lose most of their value. Even safe public utilities have a failure rate of over 10%. But what about the companies that do survive? They're driven by tails inside of tails. In 2018, Amazon alone drove 6% of the entire S&P 500's returns, and that was almost entirely due to Prime and Amazon Web Services, tail events within a company that has tried hundreds of failed products. Apple drove almost 7%, driven overwhelmingly by one massive tail product, the iPhone. And the people building these? Even the hiring rates reflect this dynamic. Google accepts just 0.2% of applicants, Facebook 0.1%, Apple 2%. The workers building these tail projects have themselves beaten impossible odds just to have tail careers.
Moving on to Section 3, your behavior over time. Let's zoom in from all this massive macroeconomic data directly to you. How should you, the everyday viewer, apply this understanding of tail events to your personal financial behavior? Well, Napoleon once defined the military genius as the man who can do the average thing when all those around him are going crazy. In investing, it is exactly the same. Most of the time, the decisions you make today or tomorrow won't matter nearly as much as what you do during the tiny fraction of days, likely 1% of the time or less, when the market panics and everyone else is absolutely losing their minds.
Let's put some hard math to that idea. Look at this comparison of 3 hypothetical investors who saved exactly $1 a month from 1900 to 2019. That's 1,428 months. Sue invests her dollar every single month unconditionally, rain or shine, completely ignoring all the terrifying economic news. Jim gets scared during recessions, holds cash, and buys back in when things finally look safe. Tom is a bit slower. He sells 6 months after a recession starts and buys back 6 months after it ends. Look at that final wealth column. Sue ends up with over $435,000. She beats Jim and Tom by a mile, ending up with almost 3/4 more money. Out of those 1,428 months, about 300 were during a recession. Just by keeping her cool and doing the average thing during those rare, punctuated moments of terror, Sue wins. Your lifetime returns are determined by your response to rare, terrifying tail events, not the years spent on cruise control.
Which brings us to Section 4, the power of failing. This is perhaps the most difficult psychological shift required to master this concept. You have to accept that frequent failure isn't just a possibility, it's a mathematical necessity. Legendary investor Peter Lynch sums it up beautifully right here. If you're terrific in this business, you're right 6 times out of 10. Think about that. If you are flying a plane, you must be perfect every single time. If you are a chef, you need to be good nearly all the time. But in investing, business, and finance, it just doesn't work that way. If you are an absolute rock star, a historic great, you are right just over half the time. That means you are wrong frequently.
The most impressive people out there are packed full of horrendous ideas, and they know it. When Amazon launched the disastrous Fire Phone and lost a fortune, you'd naturally think the CEO would grovel to shareholders. Instead, Jeff Bezos didn't mince words. If you think that's a big failure, we're working on much bigger failures right now. Some of them are going to make the Fire Phone look like a tiny little blip. Bezos actively embraces massive failures because he deeply understands the math. He knows it's perfectly fine to lose a lot of money on a flop because one huge tail event, like Amazon Web Services earning tens of billions, will come along and cover all the losses and then some.
We see the exact same philosophy at Netflix. When CEO Reed Hastings announced they were canceling several big-budget shows, he didn't apologize. He flat out said, "Our hit ratio is way too high right now. You have to try more crazy things because we should have a higher cancel rate overall." Top CEOs aren't just tolerating failure, they are actively courting it. They know for a fact that to find the elusive tail events, the mega hits, you have to push the boundaries and accept a very high volume of duds.
And this isn't just corporate strategy, it is the creative process too. Consider how comedic genius Chris Rock operates. We usually only see step 3, the flawless, hilarious Netflix special. We assume he just walked on stage and was perfectly funny. But that special is just the visible tail event. It's built on step 1, performing in dozens of small clubs like the Stress Factory, and step 2, literally fumbling through notes and cutting bad jokes mid-skit. No genius is smart enough to preemptively know exactly what will work perfectly. The final masterpiece is just the tail sticking out of a vast universe of failed attempts.
We even see this with the ultimate investing icon. Warren Buffett owned between 400 and 500 stocks in his life, but he made most of his money on just 10 of them. Nobody talks about his dud picks or his ugly businesses. They only ever talk about the hits. But as his partner Charlie Munger pointed out, if you remove just a few of Berkshire Hathaway's top investments, its long-term track record becomes entirely average. We so often overlook that our role models' massive gains come from a tiny, tiny percentage of their actions.
So, the crucial point we really need to walk away with is perfectly captured here by George Soros. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. This should completely shift your paradigm. You can be wrong half the time. Your projects can fail, your stocks can drop, your jokes can bomb, and you can still make an absolute fortune and be wildly successful. It's all about the magnitude of the tails.
I want to leave you with this somewhat mind-bending thought. Think about the universe for a second. There are 100 billion planets in our galaxy alone, and as far as we know, only one has intelligent life. The very fact that you exist and that you are tuning into this explainer right now is the result of the longest tail event imaginable. It is the ultimate proof that out of billions of duds, one spectacular outlier can change absolutely everything. Tails really do drive everything. Thanks for watching, and keep looking for those outliers.